Hello, everyone, and welcome. Thank you for joining us today for our webinar on lessons learned from tax season for 2024. My name is Sarah Campbell. I'm USDA's Beginning Farmer and Rancher Coordinator. At USDA, we have a taxpayer education and asset protection initiative. You can find all of the information as well as the materials that are going to be in this webinar, the recording, and all the other prior webinars that we have had, as well as a lot of different fact sheets and helpful links on farmers.gov/taxes. As a reminder, this webinar is being recorded, and if you have questions during the webinar, put them in the Q&A box, and then we will go through all of those questions at the end of the webinar. It usually takes us about a week or two to get everything captioned and cleaned up and once we finish the recording and the webinar. So it'll be about 2 weeks before this gets posted live online. But just like to remind folks, it will be online. Everything will be there. So don't worry if you miss something or you want to watch it again. So without further ado, I'm going to hand it over to JC Hobbs from Oklahoma State University and Guido Vanderhoven from NC State. Talk you through it.
Thanks, Sarah. Thanks for joining us today. This is, we hope to be a very good session. Guido, if you'll go to the next slide, please. So our material is basically put on a website from Utah State University. They are our host. This material is developed, managed, and owned by the National Farm Income Tax Extension Committee. And we have a lot of information available on our website, and it's at ruraltax.org, which is on the left-hand side of your screen. There's also a QR code that you can use to access that. We've got materials on agricultural issues, timber, and various other rural tax topics. We have a list there, but that's just a sample. Our list is much broader than that. And just go to the website and kind of bounce around. You'll find all kinds of interesting things to look through, hopefully answer your questions, provide information, etc. Our disclaimer: this material put together from work supported by the USDA. Our agreement number is there. Real quick, make sure you understand that this material is for educational purposes only. So our opinions, our findings, conclusions are based upon the authors and the presenters today, so Guido and myself. For more information or more detailed information concerning your specific situation, you want to reach out to your tax preparer, your tax professional, so that they can walk you through and get answers to your specific issues and items. Again, remember, this is for educational purposes only. Guido, with that, I'll turn it over to you to talk about our program today.
All right. Well, thank you, JC, and thank you to those folks who are online and attending this particular webinar. Glad to be here today. And what we've decided to do between JC and myself, we've identified 10 lessons that were learned as either he or I or some of our colleagues around the country had received questions about what's going on, how should we approach this during the tax prep season. And we're going to try to discuss this maybe in a somewhat of an informal manner, kind of like a coffee chat, if you will. But at the end of the day, we hope that this information will be useful. And as I said, we have 10 or so of these items, these lessons that we want to review. And so with that, why don't we get started? So the first one is that apparently there are some systemic processing issues that we have noticed and with our colleagues around the country. The first one is that there are sometimes there are letters being sent by the IRS that are being received by farmers indicating that their return was prepared in error because they're not being treated as farmers for estimated tax purposes. So in previous webinars, we've talked about who is a farmer, what's one of those definitions that we look at, and if they're 2/3 of their gross income comes from gross farm income, so that would be typically line 9 of Schedule F if we're a sole proprietor, and that is 2/3, then they have the option to pay the tax return, file the tax return, pay any taxes due by March 1 without any penalty. And apparently something is systematically in error because I've talked with our colleague in Kansas as well as in Illinois, and seemingly some folks are getting these. We think that it is possible that the software, when these returns are being processed, may be identifying and picking up net farm income instead of gross farm income, but it does result in a miscalculation, and the letter indicates that you're not a farmer and there may be interest and penalties being assessed. And we believe that that is a systemic error at the IRS. Another one that JC and I have talked and run into is that sometimes if the farmer has utilized farm income averaging, that the software, when it does the math check, comparing the software of the tax preparer and then IRS's software looking at the return, they're coming up with two different answers. And actually, it seems to be that IRS is issuing refunds indicating that the tax preparer used an incorrect formula to prepare the return when they use farm income averaging. And we've gone back and checked this against other returns, and we feel that the tax software is correct, but that the error is on the IRS and their calculation. And we've had a few folks say, well, we've sent them the check back. They sent the check again. And some folks say, well, if it's twice back, I'm going to just deposit it and hang on to it, not spend that money. But I know that sometimes when letters from the IRS are received in the mailbox, folks may get their blood pressure raised just a little bit. So what's going on here? And then in this particular case, if there's a check and says, hey, they go down to their tax practitioner and say, why am I getting this refund when we talked about it and said, so that's something that has come up. There's also a third one that we've seen, and that is letters that are indicating that the farm used the incorrect farm optional method for self-employment tax calculation, particularly when it's linked with claiming the earned income tax credit. And so these we feel are possibly some internal systemic processing issues. JC may have additional comments that he might want to share.
In our discussion with some of the folks at IRS or with IRS, the question or some of their reasoning for why some of this may be happening is a lot of their experienced folks have retired, and they have a lot of new individuals that are not quite as experienced specifically in the area of agricultural tax issues. And so this may be an indicator of what's going on and why these things are popping up. But again, we're not really pointing fingers. We're just kind of explaining that this is what may be occurring and why these letters are going out and why things aren't being fixed in a quick and reasonable manner.
All right. Well, thanks for that, JC. I'm going to move to the next slide that we have, and this one is maybe a little bit more common. I'm going to let you, JC, take the lead on this one.
Thanks. So what the issue is here, we've got farmers and ranchers that will have a Schedule F, and they're filing their farm income tax because that's where you put it. And then in a process of wanting to diversify their income sources, they'll often or frequently start into a process where they're making jams, cheese, or other things, value-added items, so that they can sell those from their farm. So what typically happens here, those sometimes get reported on F. Well, you'll notice there in that first line that we talked about de minimis farm, non-farm sales, which was where these actually go. Normally, we would put those on Schedule C. So it would be for business income and expenses being reported on Schedule C, where Schedule F is for farm business and expense items. So the question comes up, when should we or how should we break those apart? Because it's often those in a early years, it makes up a very small portion of their overall farm income or gross income, taxable income. Usually we think of it being less than 5% of the gross. Then we look at it saying, maybe we can use a de minimis rules and go ahead and report this on Schedule F. But once it gets to 5% or more for those non-farm business activities, we probably should be looking at putting those on Schedule C. So those non-farm activities, even if the farm assets are being used to produce those, for example, agritourism, we're using all the farm assets, we're bringing people on. We're allowing them to look at the farm operation, we're looking at the machinery, the equipment, how things operate, etc. So the agritourism is truly a Schedule C type item. If we make jams and jellies, if we produce milk and take milk and produce cheese from it, or if we're making pies, anything else value added, and we're selling those on the farm, those really truly are Schedule C items. Even if we take them to a farmer's market, they should be reported on Schedule C. But again, remember, a lot of times we're talking at the early stages, this makes up such a small amount. Also, if one of our side businesses is consulting in an area of our expertise, we have some farmers that actually consult with new beginning farmers. Sometimes they're paid. When they are, that business is treated as a Schedule C business. So side items such as consulting, that's a non-farm business, even though the farmer is providing that. Based on their area of expertise, consequently, that should be reported on Schedule C as well. So there's some issues or some questions that arise, and they arise regularly, with the farmer coming to us and saying, well, when do I move it from Schedule F to a Schedule C? Or the tax preparer does likewise. Is this an F or a C form that we need to be filing, schedule? And we're trying here to basically educate again what the rules are and when to apply those to move income from Schedule F onto Schedule C. Guido, if you've got anything else?
One thing I would like to point out is that for some folks that they are having their farm operation, and when they do the non-farm, particularly I'm looking at agritourism, they may be creating and forming a separate entity like an LLC because they are engaging with the public on their farm property, and they may want to limit some liability. That LLC, if it's a single member LLC for income tax purposes, it's going to be treated as a disregarded entity, which is a fancy way of saying, well, we understand you formed this entity to protect liability, but for income tax filing purposes, you're going to do a Schedule C if it's as a sole proprietor. Again, there could be a partnership involved here. There could also be a corporation, either a C corporation or a sub S corporation that could engage in this. But what we're advocating here, or what we're looking at here, is that we want to clearly separate farm activities from non-farm business activities. And when I was doing tax preparation more on a full-time basis, I kind of used that 5% as a de minimis, as kind of a rule of thumb that I used. There's nothing formal about that number, but it does make a measure of sense that at some point in time, if it looks like the non-farm business activity is growing, then we should really treat it as a separate entity and have a separate set of books, et cetera. And we've just kind of seen this particular question pop up. Well, I'm doing this or I'm doing that. We see it with particularly some young folks that are very excited and active in farming, but what they're trying to do is grow that business on all fronts, and particularly with that value added side of the business. And that this is just not necessarily a cautionary tale, but it's just, this is really how we need to think about this in the context of operating two businesses, even though it's reported on one income tax return in making the assumption that both of the businesses are sole proprietors. But I just want to point out, we could have a different business entity that is standalone in and of itself, and then that would flow through any net income or from that business to the individual's return, depending on how that entity was put together. So the next one is a lesson that we have, or I put it here as issues, and I'll take the lead on this particular discussion, and then I'll let JC chime in after he has a little swallow of that coffee that we've been talking about. And the first one is a little bit that there's a misunderstanding relative to recovery periods. So I've seen it on returns, and I have gotten questions over the years, and even a few this year. So I bought XYZ type of equipment. How do I depreciate it? What do I need to do? And really, there are three kind of major bullets on this particular slide. We don't necessarily want to go into a whole lot of detail per se, but just suffice it to say, if we look at that first bullet, the misunderstanding of recovery periods, that for production agriculture, when we see assets being purchased and placed into service in farming, then there are these 6 different recovery periods that are generally used: the 3, 5, 7, 10, 15, and 20 years. Now, when we had the Tax Cuts and Jobs Act that was passed in the late part of 2017, it did change some things. Namely, agricultural equipment prior to Tax Cuts and Jobs Act was a 7-year recovery period type asset. Now there's been an addition or change in the law, and they've gone to 5-year for new equipment. And that means new, bought from a dealership, for example, and that the individual that purchased it is going to be the first person to place that equipment into service. So it still has all the paint. It doesn't have any rust. It doesn't have any scratches, etc. It also changed that we have a way to recover that during that recovery period a little faster in the front half by using 200% declining balance. Formerly, it was 150% declining balance, which is still available by election of the taxpayer, or you could use straight line. And then you see that second sub-bullet there to this particular discussion, and that is there is a delineation that it is 7-year assets, recovery period rather, for used equipment. Now that might be a little bit back to front, because you might want to look at it and say, well, I would think that a new piece of equipment would last longer than an old piece of equipment. Why don't we flip it? Well, because that's the way the rules work. Also part of Tax Cuts and Jobs Act, we had the extension of bonus or special first-year depreciation. Originally, it was at 100%, and then it is decreasing, as you can see here on the screen, to 0%. In other words, it's going to sunset under present law in 2026. And it just pops out. But what this does is that means that the presumption of the law is that the taxpayer will use bonus depreciation. So when it was 100%, that was really easy peasy, because I paid $50,000, for example, for a piece of equipment. The law presumed I was going to use bonus depreciation, and I had $50,000 worth of depreciation expense in the first year. Now, that may or may not be the best decision. And there's some discussion and fact sheets on ruraltax.org that explores that a little bit better, because you might say, well, I'm just getting started in farming. My income stream is starting to grow. I want to push this expense out into a future year as we move through. As my income continues to grow, I want to have that expense. I don't want to necessarily create a loss this year. So we would elect out of bonus depreciation, and then we elect out by class, and each one of those classes are represented up there by the recovery periods. And this is one of the things when you read tax law, you'll see, well, Vanderhoven, you're using the term recovery periods, but now you just talk about classes. Well, in the language of the bonus depreciation legislation, they use the word class when they probably should have used recovery period. And so it kind of sounds like I'm talking a little bit out of both sides of my mouth. One tool that continues to be of some benefit because it's not necessarily an all or nothing thing like bonus depreciation is. We can choose, we can manage a number. So that's called Section 179 expensing. And for last year, it was up, increased to $1,160,000, which is subject to some limitations as to how much we can use. But these are the flexible things, and they are wonderful tools in the toolbox. JC, do you have any thoughts that you might want to visit?
You pretty much hit all the pieces of that one. You hit the nail on the head.
Okay.
The only thing to really remember is that the 179 amounts, those are adjusted for inflation on an annual basis. So the 2024 number will be larger than that. There's also some investment limitations, and those are also adjusted for inflation. So the 179 expensing made permanent, and like I said, is indexed to inflation, so it does grow.
But I think the key thing to this is that it really isn't a willy-nilly opportunity to just pick a number. There are in the Farmer's Tax Guide discussion in the depreciation chapter about what qualifies as a 3-year asset. That would be like swine. So gilts, sows, and boars. 5-year assets would be like cattle and new equipment, as we have listed here. 7-year assets are going to be for used equipment. 10-year assets are going to be single-purpose ag structures such as greenhouses or milking parlors. 15-year assets, just real quickly, just to give folks an idea of what they might be, is a 15-year asset would be a land improvement, such as an irrigation pipe system, or it could also be terraces like that. And a 20-year asset is going to be a multi-purpose storage shed, such as a Morton building, Astro building, those kind of storage sheds. So there are different there are definitions of what fits, and so it would behoove folks to look at that. And it does surprise me, I will say that. I've had some tax practitioners say, well, can I use this particular one because it makes sense for the taxpayer? And I say, no, because the definition for this particular recovery period, whether it be 10 or 15, is that what you're talking to me about is more a 15-year asset, and so you should use that. But again, that's going to be allowable for bonus depreciation if you want to use that as a tool to manage to get to that sweet spot. Well, JC, the next slide is yours, so I'm going to just go ahead and slide there and go. So.
Yeah, the taxation of grants. This topic, or the grants, are becoming more and more prominent and prevalent, and questions from farmers, ranchers, preparers concerning taxability of grants is coming to the forefront. There's a lot of them out there, and generally a grant received from any organization is going to be considered taxable income, and we put the tax code reference in there to section 61. It explains that all items are subject to income tax or taxable income unless they're specifically excluded. Well, if you read through there, these grants for the most part aren't excluded. So they are taxable income, and they are subject to self-employment tax. The issue comes down to when it comes to the taxability. So we received the grant. Now we will typically have offsetting expenses. Sometimes usually these are greater than the amount of the grant proceeds received, because the grant proceeds are used to entice us or help us to expand our operations into different things. For example, one of the big grants that I was working on last week with a farmer, was on the food issue, food for basic consumption. So him and his wife are setting up, taking their vegetables and then going through the process of, let's see how we can build a processing so that we can then involve a new and different asset or new and different production line for our farm. With that, the grant was going to basically pay about 75% of their cost of setting this up. So once they got it into place, they would still have some expenses. So the grant portion that would be taxable would be offset by the expenses of getting this thing in place. And they would have some additional expenses that would be depreciable or deductible under the current tax code. So what we're looking at there is basically piecing out what is going on. There's some grants that we get for soil and water conservation purposes. And if you look at the rules and you read the farmer's tax guide, depending upon what's going on there, those grants and those dollars expended for conservation purposes can be excluded from income if we use code section 126 rules and follow those precisely. So there are ways of getting some of that grant money, if not all of it, offset by using some other tools, opportunities, etc. Now, one of the problems is, and when you look at these grants, like I said, from a federal standpoint, they are taxable. We've got some grants in various states. Utah, there's some, California, notice some in Oklahoma, where grants for basically food and food processing to help with various specific needs in those states. That income or those grants aren't taxable on the state level. So you may be paying tax at the federal, but on the state income tax return, they're not included. The issue is, how do you determine what those are and do they qualify as being excludable from state taxation? So you've got to look at the purpose of the grant. You're going to have to read the grant protocols very closely. But when we look at those pieces, they're frequently on the state grants. Those are not taxable in that particular state. But again, the question often that I receive is, are they taxable? Generally going to say yes. But you do have the ability to offset that taxable income in some way, shape, or form, either with the tax code, specific sections of the code, expenses, etc., that we can reduce that considerably. One of the problems, and this is where just a few weeks ago, as tax preparation time came about, I had a tax preparer contact me and he said, my farmer received a grant for developing a production process, and the farmer was in the process of doing this, and he received the grant at the end of the year, but he didn't get the production assets in place to be able to deduct those in that year. So they weren't depreciable in 2023. So we have to report the income from the grant in 2023. He will not have any expenses to reduce that until 2024. So there's some things that we can do from the tax law that allows us to go back and adjust that. Essentially, if you're looking at income averaging, where we have a large amount of income that occurred last year, and we weren't able to reduce it through those expenses, there's other things that we can do to help give us some relief, but it requires some tax planning. It requires some work with your tax preparer and visiting with them early on so that we know what we can do to maybe reduce some of that tax issue when we receive the grant income in 1 year and the expenses won't be deductible, or all the expenses or a majority of the expenses won't be deductible until the following year. So again, requires some tax planning, some tax thought. Guido, if you want to add to that, please feel free.
Well, I just want to kind of highlight that last little comment that you made, and that is the timing issue. Sometimes it is useful, and we've had some conversations with folks inside USDA saying, essentially, I know we've got these funds available, looking at how they're going to be distributed, how the timing is going to happen. Really don't want to receive it, let's say on December the 20th, but having received it on January the 10th, basically 10 days, 2 weeks later or so, that really helps, as JC was illustrating, to be able to manage that tax liability with those expenditures. So the thing would be is there a way to understand when the grant funds may be released and when they might hit your mailbox? Is that going to be something that you could have some input? You as the producer could have some input in as it moves forward. And I know that folks in the granting agencies are aware of this. Sometimes they've got other jobs that they're attending to as well, and this grant program is just one of their responsibilities. But it does, as JC mentioned, it can cause a little bit of consternation, but with some communication and potentially using income tax averaging, it can help smooth things out over time. Let's look at one of my favorites. And this is one that's popped up a couple of times this year when I've had conversations with tax practitioners, and that is, can we hire the owner's children to work in the business, particularly in the farming business? And if so, do we have to treat them like regular or normal employees? And the answer to that is, yeah, generally that is true. We can hire them. The one thing to think about is that there needs to be some economic benefit for which the children are being paid. They need to provide that to the business. So it could be to mom and dad, or if they're running a business, it could be to the partnership where the parents are the only partners. And if that's the case, if you make that qualification, then they can hire their children who happen to be under the age of 18 without any required federal or FICA withholding for Social Security. The question this year that I was specifically asked was, does that rule apply to grandparents? And the answer is no. The code is pretty clear that it's that parents, and then they make that exception for partnerships where the parents are the only partners. So you've got basically two partners there, that you can hire the kid. Once the child turns 18, then there is going to be that requirement generally to withhold FICA and federal income tax and just treat them as a normal employee. Now, the question then arises, well, what about rules for LLCs, corporations, or partnerships? And I've got a little bit there, the partnerships with other family members, such as aunts and uncles or cousins or, grandparents or whatever. That is going to not meet that qualification that you see in that first set of bullets there, where the parents are the only partners in that partnership. An LLC and a corporation, those are going to be recognized generally with the Secretary of State's office as a separate entity. And so if children are being hired, even if mom and dad are the only members or shareholders, the issue is they are a recognized entity by the state and they fall outside, even if the LLC is being taxed as a partnership. So it's one of those nuances. So the question is, and I think it's pretty clear at that first bullet, if it's mom and dad or they're a partnership and mom and dad are the only partners in that, then the kids can be done. Question comes up, well, how young? Well, I worked with a dairy many years ago where the 4-year-old was paid a wage about $1 or $2 a day, and that 4-year-old's responsibility was to feed bucket calves. So one of the older siblings would manage and actually do the mixing, but the 4-year-old then would go and get the bottles and put the bottle into the rack, and they would receive a wage of $1 to $2 a day. And so was there economic benefit being provided by this 4-year-old? Yes. Was the 4-year-old supervised? Yes, by an older sibling. And so here's an example of how we could use the children to basically train them up, even when they're young, such as the 4-year-old. But it needs to be somewhat reasonable. I don't know that you would want to pay a 4-year-old $40,000 to feed bucket calves. And of course, there's going to be some economic constraints, obviously, in doing that. But I think a little bit of common sense and applying those kind of, okay, we got a 4-year-old, we're going out, $2 a day, because you got to feed the bucket calves in the morning before school, and you're going to feed the bucket calves in the evening. So, that's how it was done. JC, you got any thoughts on this? Have you seen this in your neck of the woods?
I have, and usually when I get the call or people wondering about this, their desire is to create earned income for that child. The last one I received, the parents were wanting to have the child get earned income so they could have that person start setting up an IRA. But you got to remember, there has to be an economic benefit, and you're probably going to need to go and have some information put in the file as to why the child is being hired, what their duties are, making sure that we know that that child has basically an arm's length reason for being employed by the parents. Then we can create that earned income. Then we can look at using that earned income to fund IRA for that child. That's the one I received probably about 3 weeks ago. A very unique scenario. Problem was we didn't have all the pieces in place for this year because the parents paid him for 2023. Didn't have all the forms necessarily filed with IRS at the time to make sure that they were considered as an employee. Consequently, I told them we wouldn't necessarily want to do that for 23, but to get all the paperwork done and get things in process for 2024 so that we meet all the requirements for that child. That's the big one I've got. Back to you, Guido.
All right. Well, our next issue or our next lesson that we've learned is more in your neck of the woods, JC. This has to do with the recent fire losses that we've read about in the popular press down in Oklahoma, Texas, and New Mexico way.
And worse than that, looking at it a little bit, this is the fourth worst year for fire since 2011. In 2024 so far, we've burnt 1.8 million acres nationwide, a little over 12,500 fires. So this is not just necessarily a local issue, it is a national issue. And depending upon where you're at, it could be as small as a few acres to as many as I think I saw 1,000 acres that a farmer lost. So you're looking at what can be done with these losses. They're casualty losses. They weren't set by the farmer. They happened. Some of them were lightning. Some of them were high winds that caused a spark in the power lines, etc. So it's a true casualty loss. In some areas, you have to look at whether there was a disaster declaration. That gives us some other benefits when it comes to these casualties. And these disaster declarations can come from different sources. The president can work with another organization or agency such as FEMA. He can also announce up on his own that this area should receive a disaster area declaration. Gives them some benefits for federal relief. Same thing with FEMA, federal relief. What we do there. And then depending upon if it's losses to forage, livestock, etc., the Secretary of Ag can get involved. And there's also some state situations where the governor will declare that area a disaster area for state relief. Now, from the state point of view on a declaration, it doesn't necessarily go up to the president or agencies. Sometimes it can, though. So the issues are, when you look at these fires, what are we losing? Most of the time, we're losing a lot of pasture and feed. Other farmers, so this recently occurred in western Oklahoma and the Texas Panhandle, where it burnt a lot of pastures. Farmers in the east side of the state wanted to donate feed, hay, etc. to those folks. The question then comes up, how can I get a deduction for that? The problem is the farmer that raised that hay has taken a deduction on his tax return for all the costs of raising it and putting it up, getting it stored. And so consequently, it has a zero tax basis. So it's already been taken as a deduction on his tax return. He just doesn't have to report the income when he sends that to the folks that need it. So you're looking at a situation in that scenario where there's no loss or no deductible donation. The tax law reads that you're looking at the fair market value or basis, which is less, whichever is the lower of the two. Most often I find it's the basis because it's all deducted. Sometimes we do, though, have a situation where all the expense is not allowed, so they have some basis in that commodity. That's a rarity. Don't see it often, but it may have a little bit of a fair market value. Therefore, it may have a small amount of deduction. Like I said, most often it is zero. So when we get into the other losses that can occur. So you have on the farm, you've got personal property. Now, when we say personal property, that doesn't mean it is just for myself. It can be business property. It just does not apply to real estate. So we're dealing with non-real estate property. Different rules applied based upon the type of asset that it is. Business assets, such as cattle, equipment, machinery. Losses there, if we have a disaster declaration, are allowed to be treated differently. In other words, if we lose equipment, we have the ability to buy it back, or if it's insured, rather, we have the ability to buy back that and not pay tax on that in insurance proceeds. So we really got to look at this very closely. Non-business assets, that's your residence, your car, furniture, etc. If the home is insured, you're going to receive insurance proceeds. Problem is, again, from the standpoint of the tax return, if you're going to take a deduction for some of that, there's a $100 rule that applies, and there's an adjusted gross income limitation. But most often, since it is a residence, even though it was insured, since it's non-business, those get offset by the repurchase of the house, rebuilding the house, etc., car, furniture, those types of things. When we start replacing them, frequently the insurance proceeds are going to be much less than what it takes to replace that. Often there is no tax consequence of that. But you have to remember, if there is such a consequence and it's an itemized deduction that's allowed, you've got to look at those the rules and the limitations that do apply. And remember, what you're talking about is the insured versus the uninsured. So you've got to look at, is the asset insured? If it is, there's one set of rules that apply. If it's not, there's another set of rules that apply. And you have to look at each specific area, and you have to look at whether or not there was a disaster declaration with it. In some of our western Oklahoma counties, the population in those counties is so sparse. This last year, we have not received any disaster declarations due to these fires. Now, the tornadoes that went through, in those scenarios we have, but fires have not. So you really need to look at and go to the website. There's the website for looking for the presidential. That comes from FEMA. It's listed in the Farmer's Tax Guide. The Secretary of State, if you go through, or Secretary of Ag, if you look at the USDA website, disaster declarations from the Secretary of Ag are listed as well. Sometimes those presidential declarations are included in there. So you'll want to look at, where are you? Go to the websites, double check, make sure that your area or your county qualifies, and then apply the rules for the different types of losses that have occurred. Guido, I know you want to add to that. Jump in.
There's just one fine point. I think you covered most of it, and that is with Tax Cuts and Jobs Act, we did lose the casualty losses for non-business unless it was in a federally declared disaster area. So, for example, if my car's parked on the side of the street and it gets totaled by somebody that ran into it, that's a casualty loss. It's not that I did it. And let's just say that I just had liability insurance on the vehicle and didn't have full comprehensive coverage. The car was worth, let's say, $10,000, totaled out. I have a $10,000 loss, but because that was an individual one, I am not going to be able to take a casualty loss on that personal vehicle. So that's another thing that's just a fine point. That may sunset on January 1, 2026, because it was part of Tax Cuts and Jobs Act, as we had. But I think JC brought it out with the focus on, generally, we're looking at business property, but we would not be doing our job if we didn't at least mention the non-business assets such as listed there on the slide. Another issue, and this is one that has come up, and JC and I have talked about this one a little bit. So essentially what we're talking broadly here is what we refer to as Code Section 1033. This is the involuntary conversions rules, and there are some under subsection or subparagraph E. This is where breeding animals can be, because we had to sell those excess animals. If my normal sales of these animals was 10 to 15 head a year, but in some past year, I ended up having to sell 50 head. So 40 would be excess animals. That 40, that income that I would receive could be deferred. Now, generally, it's going to be the year of the issue plus 2 extra. And then if the drought situation continues, then we also get additional 1-year extensions. And JC shared with me earlier today a spreadsheet just from Oklahoma, and I quickly looked at it. There are several counties in Oklahoma that have had 13 years of drought. And there's one county specifically, it's Ellis County in Oklahoma, that's been 18 years. So it has. So the issue that came is this second bullet. A farmer or rancher changed their mind on replacing those deferred cattle. What do we do? Well, the way 1033 works, it essentially keeps open the statute of limitations. And it says, okay, we can defer these cattle. If I had deferred on those 40 head, like in my earlier example, and let's say that I'd gotten $50,000 when I sold those, I was deferring that, reporting that income until I bought those animals back. Well, now I'm changing my mind. It's been 10 years. I'm in one of those counties in Oklahoma that, it continues. I'm 10 years older. And then I realized, I think I'm going to change and do something different. So the rule is I changed my mind. Now I have to go back and amend that tax return where the cattle were first deferred. So I got to go back 10 years. And I'm going to amend that particular return and then recognize and then pay tax on that $50,000. Well, the issue that JC and I came up with is that this was a question that was asked, and we thought about it a little bit, and I said, well, why don't we just, and what the issue was is that there were some educational tax credits and there were some child tax credits, and if we brought that income back in, we were going to lose those. So not only were we going to have to pay tax on the income and pay interest because we've had the usage of the money, we don't get a penalty, but we do have to pay a little bit of interest on that. But we also have to pay back those tax credits because our income level was up and above. So I kind of suggested, I said, well, why don't we buy the cattle back just to preserve those tax benefits of the past? And there are just 3 of them listed. 2 of them were in this particular fact pattern. And then sell those repurchased cattle in a subsequent year. So you look at it and say, hey, isn't that paying a little bit loose with the tax rules? I don't think so. So maybe you go back and buy those 50,000 head of cattle back in late November or sometime in December, and then you turn around and sell those animals back on the market. You might make a little bit of money, you might break even, you might even lose a little bit of money. But I think the issue is now we've got that income in a tax year, and now we've got 15 months to manage that income and figure out how we're going to, what we're going to do. So we've got a longer planning horizon. We've got another 15 months before we have to recognize and pay tax on that income. And like I said, so the tax liability could be less than this year, it could be the same, or it could be more depending. Now, there is one rule that kicks in, and that's at the very bottom of this particular slide. And that is if the taxpayer passes away. So if the farmer or the rancher passes away and not having replaced those deferred cattle, then the estate is going to have to go back and amend that original return and pay the tax and a little bit of interest. But we're looking at that scenario there. It's a timing issue. But again, if the taxpayer has died, the taxpayer is not going to be in place to buy those back. And it's going to be the executor that's going to have to act on behalf of that decedent and then pay those back. So a little bit of a tax planning issue here, looking maybe outside of the box, trying to preserve those tax benefits that may be 10 years old. And we just have to look at it. JC, you got any thoughts on that?
I brought that question up with a retired IRS auditor, revenue agent, and I posed this very scenario to him. And when Guido said it might be a little shaky, his comment back to me was, if you look at the tax code, there's nothing that really addresses it. And he said, if the IRS questions what's going on, which in his opinion, he didn't feel like would be the case, he said, I think we've got something to stand on. And next comment was, says, if it was in a drought when they did it, what's to say that when they buy those cattle back this year, we might not have the same problem next year, or even if we came out of the drought scenario, is that going to bring back all the pasture? He said, from a production point of view, he said, I could think we could defend, or a farmer could defend this without any problem, making that decision to buy those cattle back and then to sell them in the subsequent year. So it very well may work. It'll have to be put to the test to see if it really does fly.
All right. Well, thanks, JC. Let's move on to this one. This one's always fun.
Really fun. So farmers and ranchers create these entities, LLCs, corporations, sub S or true closely held C corps for their farm. And we forget, once we create that entity, really who owns the stuff that was put in there? Who owns the assets that were put in those entities? I get questions from farmers saying, well, that's still my stuff. No, the statement that it is still my stuff is not quite correct. Now you own the entity, but the entity now owns the assets. It has control. So you've got to remember to separate the entity from the entity owners, equity owners, the individuals that put the things in there. That can be the LLC members who now have a membership interest, or it could be the shareholders if we create an S Corp or a C Corp. Once we do that, then we have to remember now as an individual to get the benefits of that limited liability company or those corporations, and that benefit being limited liability or protection from loss of the assets if something happens. In other words, what I'm meaning by this is we put items in the corporation or the LLC. By doing so, my personal assets are protected if something happens and the entity is sued. So my personal assets can't be brought in there if I protect those and avoid the next bullet there piercing the corporate veil. So as long as I don't pierce the corporate veil, make my assets, my personal assets, a possibility of being included in the corporation or the entity itself, then I can keep those two separate liability is limited, or that loss is limited from that liability to the entity and not to my personal items. So what does that mean? Corporate veil. Basically, if you look at the corporation, everything that's going on inside that, same thing for the LLC, everything that goes on inside there should be business related. So you don't want to use the company bank account as your personal bank account. Don't take a vacation on the company bank account. Also, when you have an operating agreement, bylaws, etc., LLCs or corporations, you don't want to go do something that is contradictory to what is in that agreement. Again, don't do personal things in the business. Also, using company equipment assets for personal purposes. Don't take the company pit truck and use it for personal type items. Same thing with the cars, etc. Anything. You want to keep the company assets inside the company, its use inside the company, the personal assets outside of that. So that's what we get into on this. A lot of times I get to farmers, ranchers, well, it's still mine. No, it's not. You've built an entity. The entity now owns it. You own the entity. It's very hard for them to keep the two separate. You all have probably run into some of these things.
I
Again,
have, and you've covered it quite well, I think. And I'm looking a little bit at the time. We've got a few more of these to do, and I see we've got one or two questions that have been raised. So, but I think the issue there is just word of caution: business is business, personal is personal. Try to keep those two separate. The next one that comes up, and I've had a couple of questions this year looking at that, and this is conservation easements on farmland or on forest land. These are not new, but they kind of ebb and flow over interest. And generally, what we're talking about is the sale of development rights, where open space, where farmland, forest land is maintained. Generally, it's what I would prefer is that it's a working lands easement, so that farming can continue to under best management practices could continue, as well as forestry. So the development rights are part of the stick or the bundle of rights that we have. It's a sale of a land interest. So individuals should be expecting a Form 1099-S. And then if they receive cash money for that, then they're going to have to report either and calculate whether that is going to be a gain or a loss. And then because it's a land interest, and I'm assuming it's farmland or forest land, it was not held for investment purposes, that it's going to be a business asset and would be reported on Part 1 of Form 4797 if the property had been held for more than a year. And if the property had been held for less than a year, it would be on Part 2. Most commonly, I've rarely seen it on Part 2 because most folks have held onto that property. Then sometimes, because of the land ethic that the taxpayer may have, they may want to do a donation. And this donation would go to either a 501c3, which is a charitable organization, or a government agency, which can hold the easement. So they're holding on to the development rights. And if an individual is a farmer qualifying as such under the rules for conservation easements, then they would be able to deduct up to 100% of their adjusted gross income. And whatever they didn't use in a tax year would be able to be carried forward up to 15 years. So if it hadn't been fully consumed in the 16 years, the year of the donation plus 15 forward, then whatever's left over is lost. If the individual doesn't meet the definition for being a farmer, so then they're non-farmer, then they would have 50% of AGI, and again, carried forward for 15 years. And so that looks at donation. But more commonly now, and what has become more the style, has been a combination of sale and donation. Individuals that are interested in protecting land, whether it be for scenic views or for open space or recreation or whatever, they realize, well, we don't have enough money to buy at fair market value, so there's some kind of deal that's worked that it's going to be a sale, because they recognize this is part of the family and the owner's wealth package. But then they look at a donation, because these government agencies or these entities, 501c3s, they don't have the means to buy it out. So they work a deal between the landowner and say, okay, if we say, just for example, if we pay 50% fair market value, we'll give you a donation for 50%. And oftentimes that donation can offset the taxable consequence of the sale, depending on the fact pattern. The key is that we need to have an appraisal and calculate what that conservation easement is going to be worth. So essentially, you're going to have two appraisals, one with all of the sticks together, and then you're going to have one where the development rights have been pulled out. And so, just as an example, I got some farmland, it's worth $10,000 an acre. The development rights are worth $4,000. So when I make the donation, it's going to be $4,000 an acre. That times however many acres, times maybe 50% or whatever. But that's how it's done. I'm seeing more and more of these sale donation combinations that are being done on behalf of individuals, particularly around folks that are living in an urban area or an area where the urban is encroaching on some lands. But then again, there could be some stuff that it's a special place. It could also be some habitat that's very, very unique. So there are various different reasons, but still it's the sale and donation that's coming in. And I've had two questions, and my colleague, or our colleague, JC's colleague in South Carolina, he also has had these, and he's seeing more and more of the sale donation in South Carolina. Timber tax with a nod to the southeast, and I'll discuss this one just a little bit, looking at, and that is generally the biggest issue, the most common issue relative to the sale of timber, is that the basis of that timber is not known or what has been poorly recorded. Just as a broad thing, we acquire an asset either by purchase, we inherit it, or we get it by a gift, or it could be transferred into an entity or transferred by reason of divorce. And that's the rules are similar for gifting. So purchase, we know what we have. We're paying a couple $100,000 for this property that has trees on it. And we've got two assets. We've got the land itself, and then we have the trees that are standing on it. So we should allocate basis to those two assets. Likewise, if we inherit it, it's going to be generally stepped up to fair market value on the date of death of the decedent. And again, we're going to have land and we're going to have timber. Now, when we have gift, that gift is going to transfer essentially three things. It's going to transfer the asset itself. In this case, it's going to be land and timber. It's going to transfer the holding period, and it's also going to transfer the basis. And the basis is how we calculate whether it's gain or loss on the sale of that timber. And that thing is really crazy. I mean, in North Carolina, where I worked for quite many years, many of the individuals that I were engaged with that were tax practitioners would just roll their eyes and say, hey, timber, my first question is going to be, do you know what your basis is? And folks will look at it and say, what are you talking about, basis? So that's the number one thing. Figure out what is your cost in that timber. And I know that on the USDA site, there is a timber tax discussion of that. And I know that Tammy spent quite a bit of time discussing basis and how that gets calculated. The other issue that keeps popping up is the taxpayer in the business of timber, or are they looking at it as an investor? The sales are going to be generally capital gain treated. If it's a 1231 asset, that's a broad basket that holds business assets with the sale, or is it going to be a 1221 type asset like a capital good, like we treat stocks and bonds? So there needs to be a discussion if folks are holding timber, what is their purpose? And most commonly, in my experience, folks are going to be acting as an investor. Then it gets down to business deductions. All right, if you're in the business, then your deductions may be limited based on circumstances of the tax year. In other words, there are going to be some things like holding charges, like taxes and interest, that if you don't have a sale, you can't deduct them. They just go into the basis of the timber. And presently, the investors' deductions are really limited currently to the Tax Cuts and Jobs Act, because we don't have these miscellaneous itemized deductions subject to the 2% floor that we can deduct. And this is where these for the investor would generally be reported. And may not affect many of the folks that are on the call, or many of the folks that may be listening after this has been posted. But JC, do you have any other comments on either of these topics?
Those are pretty much what you covered, everything that we were going to discuss. You missed nothing. Let's go on.
All right. Well, this brings us to the last one. And this last issue is again, it's raising its ugly head a little bit. And this is dealing with the deduction of excess soil fertility. And what we have noticed here in the Midwest, particularly Iowa, Nebraska, and maybe a little bit of Illinois, is that there are some aggressive agronomy and consulting firms that have really latched onto this idea that when a piece of property is purchased or a property is inherited, that we have this excess soil fertility that we could basically say, okay, it has a value of so many dollars. And then we can write that off because Code Section 180, which is where we take the deduction for soil fertility for fertilizer and lime being applied, that can be done. The issue is, I think, taking this conservative position in bullet number 2. And just remember that pigs get fed and hogs get slaughtered. They're just, in my mind, there is no way, and my undergraduate degree is in soil science, so I have a little bit of understanding about what's going on and how these values are calculated. But you look at this and say, okay, I just paid, and I'm just going to say $15,000 an acre in, say, Iowa, and I want to recover some of this excess fertility. Well, number one, you have to establish that it is excess fertility. What is the baseline fertility for the native soils? And that may be difficult if this property, this farm has been farmed for now, 100 plus years. And since 2020, the 1920s, so a little over 100 years now, we've been applying commercial fertilizer to this land and maintaining it that level. Or even increasing it. And that's the key, the increase of it. And how do we measure that? And in the calculation, we need to think about, well, what's going to be the crop rotation? And what are the best management practices for each one of those? Because there's different cultural practices that you're going to use for corn and use for soybeans and use for alfalfa and whatever that crop rotation is, that you have to look at and estimating how much of this nutrient uptake is going to be taken. Our colleague from Kansas State University, we were having this discussion last week, actually, and he said, yes, we're familiar with this and it's been done, but some of the agronomy reports comes back and says that it's going to take 65 to 70 years to extract fully this fertilizer from this soil and minerals. And then it raises the question, is this even really worth it to incur the cost for the fertility study to do all of these things? And I think it's become quite a bit of the wild, wild west out here. I've done some research in 2010 and 2011, looking back at an old IRS guidance from 1992, and it was relatively a poor set of facts in that it dealt with an individual and a corporation. Just like JC was talking about just a few minutes ago, the corporation owned the land, but the individual wanted to take the deduction. And so there wasn't any benefit. What in the language of tax, there was not any beneficial ownership by the individual. It was at the corporate level. And so that was the trouble. And then when you read that position, IRS said, if you were going to take this deduction, this is how you need to do it. And they went through and enlisted basically what I've been talking about. You got to have the soil fertility report. You have to establish that there is excess fertility. And then once you do that, then you have to figure out how long, over what period of time. And if you read Code Section 180, where it speaks about, well, you're going to amortize, that's the presumption is going to be that you're going to amortize for fertilizer over a useful period, 5 to 7 years, for example. But what a lot of folks are doing, and they may not realize that they're doing, is that there is under Code Section 180C, the ability to elect to expense. And you elect to expense by simply deducting the fertilizer and lime expense on Schedule F. And there you go. You've made that election. And so when folks over the years, they're just saying, well, I spent $25,000 on fertilizer, for example, they put $25,000 on the fertilizer and lime line, they've made the election. And you do that for 30 years, well, that's what you do all the time. Now you've bought some land, you've bought some stuff, and you go through, how do you say there's excess? And there really isn't any economic incentive to over fertilize. Fertilizer is expensive. You want to follow the best and recommendations from a soils laboratory or from a consulting agronomist relative to I'm going to grow corn, or I'm going to grow alfalfa, or I'm going to grow soybeans, or whatever. You're going to look at, what's going to be my nitrogen, what's my phosphorus, what's going to be my potassium, what are going to be some of the other micro or nutrients like zinc or iron or sulfur or copper, or on those kind of things. We can value those, but taking a multi-$1,000 per acre deduction after a purchase or an inheritance, I think, is fraught with a lot of danger. JC, you got any thoughts? I've kind of run my gap there a little bit.
One of the things that I'm running into is what our gentleman from Kansas said. Now in Oklahoma, these letters have been going out. Farmers have been receiving them. I have yet to see one of the letters, but what they're truly wanting the folks to do is that we can save you lots of money. So that's their tagline. But when the farmer actually did the soil return test and study, he sent his soil samples in and got all of it back. He said, to me, there's not enough money to make it worthwhile. He said, I spent all this money getting a soil test, and the next thing I know, it didn't do what I wanted to do. I told him not to worry about the cost of the soil test. He'll get that back because he'll know what his fertilizer needs are. But his comment to me was, why are these folks doing this? And basically, it comes back to that aggressive activity of these firms. They're trying to convince farmers that this is worthwhile. And in some cases, it probably is. But it's on a case-by-case basis or farm-by-farm basis. So as you look at this, you got to kind of look at what your practices were and what all is going on inside this little bubble. With that, that's the end of my comment on that, Guido.
Okay, well, thanks, JC. So for those folks that are attending, we've come to the end of our substantive slides. We thank you for attending today and for engaging. We do have, I see one question. I'm going to see that. It says, using the farm optional method for self-employment tax, particularly in a community property, may either spouse claim the 50% of the 2/3 income. Okay, that Kansas is not a community property state, but I think I can answer that question with some kind of certainty. So in a community property state, the assumption is that it's 50-50. What would suffice and maybe be a little bit better is that if you would have both spouses filing a Schedule F, so you would split it down the middle. So spouse number one gets 50% of the income, 50% of the expenses, and thus then 50% of the net income. Or if they had to use the 2/3 rule, they would be able to do that. I think that that would track a little bit more easily and be easily defended by that. But again, there are 7 community property states in the United States. The rules are similar, but I think you need to look at the state law a little and how it ties in. But I think the federal law would allow that per se. I would, to be 100% sure, what I need to do is look a little bit more in detail, and I'm happy to do that, which is a nice segue into looking at the Janet Wright is the contact person at USDA if there are questions. And what I can do is I can look at that, and then I can provide Janet an answer, and she might be able to forward it on to you in that regard. Are there
Please
any
let us
other?
know what state you're in so that we can kind of see if there's any specific rules that apply there as well as to spousal sometimes qualified joint ventures, the word spousal partnerships, things like that.
All right. Any other questions or comments for the good of the cause? I'm not seeing any right now. So Sarah, thank you. I think we're finished here. Do you
Sounds
have any
good.
closing comments?
No, thank you folks for joining. The recording and the materials will be posted on farmers.gov/taxes. Also, make sure you're signed up for all of our alerts. We do tax webinars monthly and put out lots of new information as there are new programs or kind of new information comes from the IRS or as the tax seasons come and go. So also keep visiting farmers.gov/taxes and ruraltax.org for all of the latest and greatest. Thanks everyone and have a great afternoon.
Thank you, Sarah.
Thank you, Sarah. Thank you, Janet.
Yes, thank you, Janet.